FHA loans have helped over 40 million Americans become homeowners since 1934, yet 68% of borrowers don't fully understand how they work. Most shocking, the average borrower misses at least 2 opportunities to optimize their loans, costing them thousands of dollars. Today, we break down FHA loans using the ADDIE framework: analysis, design, development, implementation, and evaluation. This systematic approach will take you from FHA basics to mastery, revealing strategies that turn this government program from a simple mortgage into a powerful wealth building tool. I'm David Zai, a wholesale mortgage broker with over 19 years of experience, specializing in helping first-time homebuyers like you navigate the complexities of home financing. I've guided hundreds of clients through the FHA loan process, helping them avoid costly mistakes and maximize their investment potential. So you've probably heard that FHA loans only require a 3.5% down payment, making them perfect for first-time homebuyers. But here's what most lenders don't tell you up front: your credit score actually determines whether you qualify for that minimum down payment at all. Today, we're going to analyze exactly what it takes to qualify for an FHA loan using the analysis phase of the ADDIE framework, where we identify the core requirements you need to understand before making any decisions. Let's start with something surprising. The FHA loan program actually accepts credit scores as low as 500. You won't find many lenders advertising this because it comes with conditions, crucial information if your credit isn't perfect. Here's how it works. Borrowers with credit scores between 500 and 579 can still qualify for an FHA loan, while they need to make a 10% down payment instead of a 3.5% minimum that's commonly promoted. Once your score reaches 580 or higher, that's when you qualify for the 3.5% down payment that makes these loans so attractive. The 580 threshold is a crucial dividing line that can save you significant money upfront. For perspective, on a $300,000 home, the difference between 3.5% and 10% down is $19,500 versus $30,000. That's an additional $10,500 you need to bring to closing if your score falls below that threshold. Many people don't realize that the Federal Housing Administration doesn't actually issue loans directly. Instead, they insure loans made by FHA-approved lenders. This insurance protects lenders against losses, which is precisely why they're telling you to approve borrowers with lower credit scores or smaller down payments. This government backing is what makes these loans more accessible than conventional options. When evaluating your application, lenders also look closely at your debt-to-income ratio. The FHA requires that your total monthly debt payment, including your potential mortgage, should not exceed 43% of your gross monthly income. This ratio impacts how much house you can afford. For example, if you earn $5,000 monthly, your total debt payment shouldn't exceed $2,150 per month to satisfy this requirement. What makes FHA loans truly stand out is their forgiving stance towards past credit events. If you've experienced financial hardship that's impacted your credit, conventional loans might keep home ownership out of reach for years. But with FHA loans, you can qualify just 2 years after Chapter 7 bankruptcy discharge. Similarly, if you've gone through foreclosure, you'll only need to wait 3 years after the property transfers before you're eligible again. This timeline is significantly shorter than what conventional loans require, opening doors that might otherwise remain closed. The contrast with conventional loans is stark. While FHA loans accept credit scores as low as 500, conventional loans typically require a minimum of a 620 credit score, sometimes higher depending on other factors in your application. This 120-point difference is substantial in the credit world and explains why approval rates for FHA loans are generally higher for borrowers with lower credit score compared to conventional loan options. What's particularly valuable about understanding these requirements is that they allow you to make strategic decisions. For some borrowers, it might make sense to delay applying for a few months while improving their credit score from 570 to 580, saving thousands in down payment funds. For others, the ability to qualify shortly after bankruptcy might make FHA loans the only viable path to home ownership in the near term. Beyond getting just approved, there are strategic applications of FHA loans that most borrowers never consider. These aren't just fallback options for challenged credit. They can be powerful tools when used intentionally. But before we explore those strategies, you need to understand exactly what these loans will cost you beyond just meeting the qualification requirement. The reality is that borrowers with lower credit scores actually have better options than they might realize. When conventional loans shut the door at 620, FHA loans actually create opportunities with scores as low as 500. Even at a minimum score threshold, a 10% down payment is still lower than what many conventional loans require for borrowers with perfect credit. And once your credit score crosses that 580 mark, the 3.5% down payment becomes one of the most accessible entries to homeownership available today. That accessible 3.5% down payment is just the beginning of the story. Unlike conventional loans where mortgage insurance eventually disappears, FHA loans implement a two-part insurance system that catches many buyers completely off guard. There's an upfront premium that adds thousands to your loan balance before you even move in, plus an annual premium that could potentially follow you for the entire life of your loan. A cost structure that fundamentally changes the long-term economics of your mortgage. Now that we understand the qualification requirements, let's map out the complete cost structure of an FHA loan using the design phase of the ADDIE framework. This is where we create a comprehensive financial picture of what you're actually signing up for beyond just the down payment. The most significant cost difference between FHA and conventional loans is mortgage insurance structure. Conventional loans have a single private mortgage insurance premium that automatically terminates once you reach 22% equity. FHA loans, however, require two separate types of mortgage insurance premiums that work entirely different. First, there's the upfront mortgage insurance premium, UFMIP, that equals 1.75% of your entire loan amount. On a $425,000 home with a minimum of 3.5% down, your loan amount would be approximately $410,125. The upfront mortgage insurance premium on this amount comes to about $7,177. Most borrowers don't pay this at closing. Instead, it gets rolled into your loan, immediately increasing your balance to $417,302 before you've even made your first payment. Then there's the annual mortgage insurance premium, or MIP, which ranges from 0.55 to 1.05% of your loan amount depending on your loan terms and down payment. This premium is divided by 12 and added to your monthly payment. For our example home, the annual mortgage insurance premium might be around 0.8% for a 30-year loan with less than 5% down, which translates to approximately $272 added to your monthly payment. What many borrowers don't realize until it's too late is that unlike conventional PMI, this annual premium typically continues for the entire life of the loan unless you put down more than 10% at the beginning, in which case it can be removed after 11 years. This structure means that over 30 years of mortgage, you could end up paying tens of thousands more in insurance premiums than you would have on a conventional loan, even if your home appreciates significantly. Understanding the loan limits is also crucial when designing your FHA loan strategy. As of 2023, FHA loan limits vary by county, with single-family home limits ranging from $420,680 in lower-cost areas to $970,800 in high-cost areas. So if you're considering a multifamily property, these limits increase significantly, with 4-unit properties reaching up to $1,867,275 in high-cost market. These caps directly affect the maximum price of home you can purchase using FHA financing. Let's also now look at a complete set of real-world examples to understand the total monthly payment structure. So for a $425,000 home with a 3.5% down payment and a 6.125% interest rate on a 30-year fixed mortgage, here's how your monthly payments would break down. Principal and interest is $2,446. Mortgage insurance premium, MIP, is $272. Property insurance, we'll just estimate that at $354. And homeowners insurance, we'll estimate that at $97. This brings the total monthly payment to approximately $3,169. Compare this carefully to alternative financing options, especially if you're planning to stay in the home long term. When it comes to closing costs, FHA loans have similar expenses to conventional loans, including origination fees, appraisal costs, title insurance, and recording fees. The estimated closing cost for a $425,000 example will be around $6,500. However, FHA loans offer a significant advantage through seller concession. Sellers can contribute up to 6% of the purchase price towards your closing costs, a potential $25,500 in our example, providing substantial financial flexibility that many first-time homebuyers need. So let's calculate what you need to bring to closing in our example. With a purchase price of $425,000, your 3.5% down payment would be $14,875. At closing cost of approximately $6,500, and if you negotiate a 1% seller credit of $4,250, your total cash required at closing will be around $17,125. This structure makes home ownership accessible even for buyers with limited savings, though you must account for the long-term cost of the mortgage insurance premiums. There's an important consideration regarding lender requirements that can affect your FHA loan experience. While FHA guidelines typically allow credit scores as low as 500, many lenders impose what's called an overlay, which is an additional requirement beyond the FHA minimums. These overlays often include higher credit score thresholds, typically 580 to 620, even though the FHA itself would approve lower scores. This is why shopping with multiple FHA-approved lenders can yield dramatically different results for the same buyer. Now let's move on to the development phase. While lenders may create unexpected obstacles with their overlays, it's often sellers who present the biggest barrier to your FHA dreams. I've seen countless qualified buyers with solid FHA financing get rejected by sellers who aren't worried about their ability to pay, but rather about a set of property requirements that have been dramatically mischaracterized in real estate circles. Let's move into the development phase of our ADDIE framework, where we examine exactly how FHA standards apply to different properties and what it means for your home search. This is where theory meets reality, where financing meets the physical home you're trying to purchase. The biggest misconception causing sellers to shy away from FHA offers centers around the appraisal process. Many sellers hear FHA appraisals and immediately imagine a white-gloved inspector flagging every minor imperfection. The reality is far from less intimidating. FHA appraisals primarily focus on health and safety concerns rather than cosmetic issues. What exactly are these health and safety standards? The most common items that trigger FHA inspection flags include peeling paint in homes built before 1978 due to lead-based paint concerns, exposed electrical wiring, broken windows that could cause injury, missing handrails on staircases with 3 or more steps. Notice what's not on the list: outdated kitchens, worn carpeting, dated wallpaper. The FHA isn't concerned with your home's aesthetic appeal, just that it's structurally sound and move-in ready. Another powerful little-known aspect of an FHA loan is the amendatory clause. This provision actually protects you as a buyer by allowing you to exit a contract and receive your earnest money deposit back if the appraisal comes in lower than the purchase price. Sellers must sign this clause for the FHA loan to be valid, giving you significant protection against overpaying in hot markets. This is a benefit, not a burden, yet many sellers misinterpret it as a risk. Beyond single-family homes, FHA loans unlock a strategic opportunity that sophisticated buyers leverage to build wealth: multifamily properties. Did you know you can purchase a duplex, triplex, or even a 4-unit building with the same 3.5% down payment that applies to a single-family home? This is dramatically lower than the conventional investment loans, which typically require 15 to 25% down for a multifamily property. Let's put this into perspective. On a $500,000 4-unit property, a conventional investment loan might require $75,000 to $125,000 down. With an FHA loan, you need just $17,500, opening the door to real estate investing for people who thought they were years away from their first investment. But the advantages don't just stop there. When qualifying for your loan, FHA allows you to use up to 75% of projected rental income from the additional units to boost your qualifying income. This means the very property you're buying helps you qualify to buy it, a powerful financial leveraging tool that can significantly enhance your borrowing capacity. Of course, there's a catch, but it's one that creates opportunity rather than limitation. FHA loans require you to live in the property for at least 1 year before you can rent it out completely. This house hacking strategy means living in one unit while renting out the others, using tenant income to offset or even completely cover your mortgage payment. Imagine purchasing a triplex, living in one unit, and renting out the other 2. Your tenants essentially pay your mortgage while you're building equity, gain landlord experience, and position yourself for your next investment, all with a minimal initial investment. After that 1-year occupancy requirement, you're free to move out and rent out all your units, converting your primary residence into a fully cash-flowing investment property. So this brings us back to why sellers sometimes reject FHA offers despite their solid financing. The misunderstanding about property requirements, unnecessary friction in the marketplace. The key to overcoming this hurdle is education, both for yourself and for sellers considering your offer. Working with agents who understand FHA requirements and can properly communicate them to sellers make a significant difference. Consider including a brief FHA property requirement overview with your offer, or having your lender contact the listing agent directly to address any concerns. Some buyers even include a pre-inspection with their offer to demonstrate the property already meets FHA standards, removing uncertainty from the seller's decision process. Now onto the implementation phase. Behind every successful FHA approval lies a hidden decision point that most borrowers never see, but significantly impacts their chances of success. The path your application takes, automated or manual underwriting, can mean the difference between a smooth approval process and weeks of additional paperwork, higher interest rates, and stricter requirements. When you submit your FHA loan application, it first enters into what's called an automated underwriting system. Think of this as a preferred expressway for your application. It's faster, more efficient, and generally offers better terms. The system analyzes your financial data and delivers a simple verdict, approved or not approved. Most lenders aim to process applications through AUS because it streamlines the entire process for everyone involved. What many borrowers don't realize is that if your application doesn't receive that initial automated approval, your loan officer still has strategic options. They can adjust various elements of your application to improve approval odds. For instance, they might add 12 months of on-time rental payment history to strengthen your application for borrowers with limited credit histories. This single adjustment can sometimes mean the difference between automated approval and being forced into a more demanding manual underwriting process. Manual underwriting becomes necessary when the automated system cannot approve your application based on its algorithms. This alternate route involves a human underwriter examining your loan application line by line, scrutinizing every detail of your financial situation. While this more personal approach can sometimes benefit unique situations, it typically results in a more time-consuming process, additional document requirements, and potentially higher interest rates. The documentation difference between these two paths are substantial. All FHA borrowers need to provide is a proof of income, but those in manual underwriting face heightened scrutiny. You'll need to furnish at least 2 months of bank statements to verify your financial situation, detailed income documentation, and comprehensive asset verification. Gift funds present another important consideration in the FHA process. If you're using money gifted from family members, employers, or charitable organizations towards your down payment, you'll need specific documentation to prove the source of these funds. The FHA has a very strict guideline about acceptable gift sources and how they must be documented, which becomes even more critical if your application goes through the manual underwriting process. What's particularly valuable about working with an experienced loan officer is their ability to strategically position your application for automated approval. They might suggest adding a co-borrower with strong credit or documenting additional income sources that could strengthen your loan application. For borrowers with limited credit history, having your loan officer include 12 months of consistent rental income payments can significantly boost your approval chances through the automated system. The timeline for FHA loan approvals varies depending on which underwriting path your application takes. With automated underwriting, you might move through the pre-approval to closing in as little as 30 to 45 days. Manual underwriting typically extends the timeline by a week or even a couple weeks due to additional documentation and review requirements. Understanding these timing differences becomes crucial when making offers on properties, as sellers often prefer buyers who can close quickly. This timing consideration leads to an important strategy for making your FHA loan more attractive to sellers. While you can't control which underwriting path your application would take, you can work with your loan officer to get as far along in the pre-approval process as possible before making offers. Having more of your documentation already verified makes a stronger case to the seller that your financing is solid regardless of which underwriting path you ultimately follow. To navigate the application process successfully, start with a pre-approval to understand your purchasing power. Once you've found a suitable property, submit a complete application package with all necessary documentation. Your loan officer will then submit your file to the automated underwriting system. If approved, your file moves to the final underwriting review. If not, your loan officer can make strategic adjustments or prepare you for the manual underwriting process. Throughout the process, maintaining your financial stability is crucial. Avoid making large purchases, applying for new credit, or changing jobs, as these actions can derail your pre-approval. Keep all documentation organized and respond promptly to any additional information requests from your loan officer or processor. The debt-to-income ratio requirement becomes especially important during underwriting. While FHA generally requires a debt-to-income ratio below 43, automated underwriting may allow some flexibility in this area based on your overall application strength. Manual underwriting, however, typically enforces these limits more strictly, which further emphasizes the advantage of securing automated approval. Securing FHA approval is only half the battle. Knowing when to exit your FHA loan might actually be more valuable than getting approved in the first place. The little-known bridge strategy transforms an ordinary FHA mortgage from a simple path to home ownership into a strategic wealth-building tool that conventional financing simply can't match. While most borrowers view their FHA loan as a 30-year commitment, the savviest homeowners understand it's actually meant to be temporary. Now that we've explored the implementation process, let's move into the evolution phase of our ADDI framework. This critical stage is where we assess how to strategically leverage FHA financing beyond just getting your foot in the door of home ownership. The true power of an FHA loan emerges when you recognize it as the first step in a longer financial journey rather than the destination itself. Remember those mortgage insurance premiums we discussed? The fact that they typically continue for the life of the loan creates a significant long-term cost. This perpetual MIP is precisely why keeping an FHA loan for a full term is rarely the optimal financial strategy. Instead, consider the bridge strategy, using FHA's favorable entry requirements to secure a property today, then creating a deliberate plan to transition to conventional financing once your financial position improves. Here's how the bridge strategy works in practice. You utilize the FHA minimum down payment requirement to purchase the home that might otherwise be out of reach with conventional financing. Over the next 2 or 3 years, you focus on building equity through regular payments and potential property appreciation while simultaneously working to improve your credit profile. Once your credit score crosses into the mid to high 600s and you've built sufficient equity, ideally 20% or more, you refinance into a conventional loan, eliminating the mortgage insurance premium altogether. The bridge strategy becomes even more powerful when combined with another FHA advantage: the ability to purchase multi-unit properties. Imagine buying a duplex, triplex, or fourplex building where you live in one unit while renting out the other. This approach often is called house hacking, allowing you to use rental income to offset your mortgage payment, potentially living for free or even generating positive cash flow. The ability to accomplish this with just 3.5% down payment creates an extraordinary opportunity for wealth building that simply doesn't exist through traditional investment property financing. For those rebuilding after financial setbacks, FHA loans offer another strategic application worth considering. The program's comparatively lenient stance on previous credit events means you can return to home ownership much faster than with conventional options. This accelerated timeline enables you to begin rebuilding wealth through real estate equity years before you might otherwise qualify through traditional channels. Now, let's move on to my favorite part of the FHA. One particularly innovative FHA program that often flies under the radar is the 203K renovation or rehabilitation loan. This unique financing option allows you to purchase properties in need of repairs and includes renovation costs in your mortgage. The standard 203K loan requires a minimum of $5,000 in repairs, while the limited version allows up to $35,000 in repairs without a minimum requirement. This creates a powerful opportunity to buy undervalued properties, improve them significantly, and potentially create instant equity through the renovation process. So let's consider this real-world scenario. You find a property listed at $250,000 that needs $30,000 in renovations to bring it up to market standards. Comparable updated homes in the area sell for $325,000. With the 203K loan, you can finance both the purchase price and renovation costs with just 3.5% down, potentially creating $45,000 in equity once the work is completed. This approach requires more effort than buying a move-in ready home, but the financial reward can be substantial. When evaluating whether an FHA loan is right for your situation, it's also worth comparing it to other government-backed options. VA loans often offer veterans and active duty service members zero down payment options with no mortgage insurance, making them the generally superior to FHA loans when available. USDA financing also offers 100% financing for properties that are eligible in rural areas, potentially providing better terms for qualified borrowers. The strategic decision involves matching the right loan program to your specific financial situation, property type, and long-term goals. Success stories of borrowers using FHA strategically often involve individuals who initially face challenges qualifying for conventional loans due to lower credit scores or past credit events. By utilizing FHA loans, they were able to secure homes, build equity, and later refinance into conventional loans as their financial situation improved. This pattern demonstrates the true value proposition of FHA financing, not as a permanent solution, but as a strategic entry point to create opportunities for future financial optimization. This is where the real opportunity emerges. The bridge strategy isn't just a theoretical concept, it delivers tangible financial benefits. Borrowers who implement this approach often save hundreds of dollars monthly after transitioning from FHA to conventional loans, primarily through reduced mortgage insurance costs. The key is timing this refinance strategy. Financial experts recommend making this move when one of two conditions is met. Either your credit score has improved significantly, or you've built substantial equity into your home. Both scenarios create leverage for negotiating better loan terms. So remember, an FHA loan isn't the final destination. It's your entry point into homeownership that evolves with your financial journey. Let's connect for a personalized analysis to determine if this strategic approach aligns with your specific goals and timelines. I'm David Zai, Mortgage Guy, and I'm out.